The government has tried to push the new build opportunity for investors where the negative gearing then supports them. But the reality here is that a property takes 3 to 5 years to correct in a negative gear, and it also takes around 18 to 24 months to build. This is not a crisis period. We just have a government who's making policies who are a bit out of interest of the Australian population. In terms of investable suburbs, there's only around 4,200 in Australia. An investable suburb is deemed investable if there's enough transactional data around sales and rentals. Welcome to another episode of the Lazy Equity Podcast. Guys, today we're going to be doing a little bit of a different format where we're talking around just you and I about the sentiment and certainty of property investing in Australia, especially at this time of the investment cycles that we're currently experiencing. Now, this is a time in the history where we need to put a bit of a benchmark, or rather a pin, on what's going on to remember these times, but also look back at other similar times that have already occurred from the property investing landscape to sort of give ourselves a bit of a justified angle of whether it is a good idea to invest now or not. And obviously, I'm going to always be of the opinion, yes, it is, but it's really dependent on location. And today is kind of unpacking that idea around why is property always good in Australia, and why is it always such a good vehicle to put your money behind? Yes, there's a lot of opinions online, and this podcast is really there to debunk a lot of those opinions by giving some raw facts and data to give a better conceptualized understanding of why property in Australia works so well and why so many investors are really interested in getting into property. So at a starting point, we want to look at sort of the greater scheme of, I guess, where we have come from and where we are today in comparison to history. Now, today we're at the same and similar sentiment levels as what we have experienced during the COVID periods of around 2022 to 2023, where sentiment drop was at a very, very all-time low. The reality of that is that when the sentiment does drop, it opens up the market for people to potentially become more aggressive in negotiations because there's less of a desire for people to want to buy property. Now, this is kind of where we are today at the moment in these current days, although this is not a crisis. And I think that's the most important thing to remember here, is that this is not a crisis period. We just have a government who's making policies who are a bit out of interest of the Australian population. But they are pretending that this is really going to be something that is supporting them in the future. And obviously, as we've seen on the media a lot lately, that this is not necessarily the case. And we are waiting for the Senate to pass these instructions to see really what happens of the decisions once they get finalized from the federal budget announcement. But the other important part to remember here is that even though COVID was a crisis, it was not a financial crisis. So you can't really compare like for like on these different times. The crisis that happened in COVID was a social crisis. People were locked up and they weren't allowed to travel, at least not as much as what they have been over the last years. And what that did is it put a bit of a barrier and a boundary on the parameters of where people can go and what they can do. In terms of what they can do, we'll also extend out to how much money they would be able to spend to travel, because obviously we know that because of the social crisis, those boundaries were keeping people in place to not be able to travel, which would therefore be spending money. But what people then did is they nest up their cash and they realized, well, they've actually got some savings because they can't spend as much as what they would, not necessarily just on travel, but there's also just no need to spend as much because less flamboyant lifestyles require less flamboyant spending. And this was a time of reality where there just wasn't really much of a need to spend money, so it was saved. And during that saving period, people were banking up deposits, and they used those deposits as basically the foundation of making themselves secure for the future, because they're in this state of mind where people are really trying to create their nest egg of security because they feel so volatile to risk because of the recent times of COVID. So during that time, people started to buy property, but at the same time, people were starting to move into different areas. And that's the other important part here, is that a lot of people were looking for more space. And as we saw over that period where the average housing format went from 2.6 people per household down to around 2.3. And that was because people were looking for greenscapes and seascape living, where they had more choice and abundance of space in front of them. And this was a big movement that we all saw, people moving from Melbourne up to Brisbane to find warmer summers and warmer winters as well. And in that process, what happens is that properties then get absorbed, because the housing formats, which were at approximately 2.6 people per household, now being reduced to around 2.3. Now, it doesn't sound like a lot, but when you take our population of currently now 28 million people, that disbursement absorbs a lot of dwellings. And so competition really started to drive around these times, more so in recent history around those times than others. The difference now is that we are still not in a crisis. We're in a bit of a knee-jerk situation. And this knee-jerk situation has been backed off the idea that there's a political party who has the potential interests of the Australian population. Yet we are struggling to find confidence in that, and so people are holding back. The similarity between them and now really comes down to sentiment, and sentiment is the opportunity, or rather the feeling of people not having the opportunity of support. But those who look past it recognize that if sentiment is low, that means opportunity is actually higher, because there's a lot less competition inside the markets. Now, there are 15,000 suburbs, but they're really 15,000 name places is what we should be calling them, because in terms of investable suburbs, there's only around 4,200 in Australia. An investable suburb is deemed investable if there's enough transactional data around sales and rentals inside that area for a prolonged period of time. So when we talk about the markets in Australia, at the moment the media is blowing up the three main areas where we have always historically referred to and relied on as points of interest, being Melbourne, Brisbane and Sydney. Now, if the public are really relying on the markets being these three locations, which are considered to be capital cities, there's a bit of a sway of misinformed information here that there's potentially thousands of other options which are being overlooked. And that's the important part of what really needs to be conceptualized here, is that there's so many more opportunities. And when sentiment is low, it's because sentiment has been driven by these three opinions, or these three positions rather, that have been positioned with opinion from the media that poise the population of investors to then have a certain way of thinking around things. There are 110 SUAs in Australia. Now, an SUA is a statistical urban area. A statistical urban area basically means that these are kind of the areas that we like to look for suburbs in Australia that have investable data. The reason why we look in an SUA is because these are basically categorized as major employment hubs. I'm going to use a comparison here between Australia and the US, because weirdly enough, our countries are very similar in land size. Now, if you look at the US, there's 2,000 SUAs. They don't call them SUAs, they call them urban areas, and we call them statistical urban areas. But there's 2,600 versus 110. And the reality here is that when you look at how many different states and territories there are in Australia versus the US, they're quite similar in land size. There's 50 states in the US versus the 8 states and territories that we have in Australia. With those 2,600 SUAs, statistical urban areas, versus our 110, that consists of basically all the major cities that we know of, but also the satellite cities that we know of, being Rockhampton, Townsville, Geraldton, those kinds of areas. When we're looking at the number of economic hubs that create employment and diversity, in comparison from Australia to the US, the geography and the landscape is disproportionate to being able to make logical sense of how they could actually work in the same way economically. There's so much more support for employment in the US than there is in Australia, yet our land size is quite similar. And we're constrained inside Australia because we only have 110 versus 2,600 Or if you want to look at it state by state, we only have 8 versus 50. And so because of that, it means we've got a large amount of land inside Australia, which is just uninhabitable for economic development. Now, yes, the population is a very, very big difference. Obviously, there's 28 million people in Australia versus a 348 or 349 million in the US. But the reality is that there is support because there's that many different economic zones for the US to then have the option to locate to house themselves at an affordable rate because of the amount of opportunity and option. Now, I don't want to harp on too much around the difference between the US and Australia, but really what I'm trying to do is show a contrast of why the property prices are so much more aggressive in Australia than they are in the US. And that's because we don't have the privilege of as much choice as what happens in the US. We're forced towards 8 major economic hubs, and so when people are forced towards these 8 major hubs, competition naturally will drive. And so we just don't have enough developed city and economic development of capital infrastructure to support the population of Australia. And so naturally, competition and bidding happens within a very concentrated area. And those areas then basically start to rise in prices. Now, that's the very basic nature of what we see happening, and we see happening for years to come, because until we start to create new cities and new major economic hubs that can support the population growth, which, as we know, the Labour government has been very ambitious to support, we could just really expect for there to be continuous pressures inside the housing market unless we develop a lot faster. The legislations that are recommended by Labour to be put in place do have significant effects on the housing market, as well as just these population pressures. The 2 major factors here are the capital gains implications, as well as the negative gearing implications for property investors, as well as business owners, but we are speaking about property, so we're going to speak about property here. When it comes down to the negative gearing and capital gains reset, for investors that are buying at the top end of the market, let's call it those $2 million, $3 million, $4 million properties, those investors are looking to buy properties that are going to help them offset their negative gearing inside their personal finances and their personal income creation. By buying a property that is expensive, that grows at, let's call it 7 to maybe 10% in a year, which has historically been kind of the reaction that we've seen in the major cities cyclically over the last 5 years, not all at the same time. But over that period of time, if you're buying a property which is $2 million property and it goes up by 10%, you've made $200,000 in that year just off that asset. Now, deducting the negative gearing benefits from your wage makes it a logical decision to buy that asset, because the holding costs then come down because it's reducing your actual income, which you would be used to pay off the mortgage. And that makes logical sense. But now that's been taken away, or that's at least potentially going to be taken away. Taking that away then means, well, what incentive do the top end of investors now have to invest in those properties? Not much. So they're going to go and look for the next opportunity. The government has tried to push the new build opportunity for investors where the negative gearing then supports them. But the reality here is that a property takes 3 to 5 years to correct in a negative gear, and it also takes around 18 to 24 months to build. Let me break those down. 18 to 24 months to build a property. So let's say you assume or you make a decision today to get into a property. And within 24 months, that property is now on the ground. It is now in your hands. It is now your property in your portfolio because it's finished being developed. That property takes generally around 3 to 5 years to correct towards the median value. What I mean by that is that you will always buy a new property at the top price point of any market. And that is the absolute basics of buying a higher price point property. You're buying at the highest percentile of that market. Now, everybody that knows anything about property investing will know that you will be the best benefiting investor when you buy at the median price point or below. But the median price point versus the 90th percentile, so 50th percentile versus the 90th percentile, that recovery time frame for a new build asset is around 3 to 5 years. And that means that as time goes on, that property needs to depreciate in value and get older over time until the median price point rises up to that same price point. That's around 3 to 5 years. That means that if you are buying a new build property, you're going to be waiting up to 7 years for this property to really make justified sense, What investor really wants to make a 7-year commitment on an asset that isn't going to return from them if they're trying to be an aggressive investor? Logically, that doesn't really make a lot of sense, because we always know that the negative gearing structures are a nice to have. They are not a structure to consider. And I think that's the part that the government has really missed there, is that they think that capital gains tax is really a strategy, but it is not. It is a nice to have on top of your strategy. So where will then sophisticated and knowledgeable investors go? They're going to go back into the competitive markets, the ones that they can afford to buy in. Why will they go there? Because the capital gains incentive that doesn't exist inside the higher price point markets, and also they don't want to wait for those capital gains, so those negative gearing incentives to exist 7 years later, or at least it doesn't make logical sense to, because they're not getting the capital return, will then go into the lower price point markets, because lower price point markets have yields that are more aggressive than the top price point markets. Those multi-million-dollar property markets have got around 2.2% yields at a comfortable best level. When you come down to properties that are price pointed at around the $600,000 to $700,000 mark, you're going to be finding properties that are gearing around the 4 to 4.5% yield. That means that those rental incomes will justify the holding costs of what a multi-million-dollar property would have if they had the negative gear incentives. So this means that competition could potentially be expected to come back into the more affordable price point markets, where it's already competitive, being fueled by investors with bigger, deeper pockets. And when you take an investor who's got their budget for a $3 million purchase and they're trying to buy a $500,000 property, they can buy 6 of those. So the competition belt then stimulates even further. And this is really where the government's just missing the mark, because property investors are very astute. They understand the decisions they are making. They are putting a lot of money towards decisions that are going to capital return of their futures being benefiting from the decisions they make today. They're not going to just take a punt and put money at something. Ideally, they're not, because there's a lot of sentiment that's been dropped around why property should be considered as a good vehicle to invest in. And so once that sentiment starts to turn, it'll be turning because there's enough education around it. And hopefully this video serves as a part of that education. So where will they start to look for yields? Because that's where those yields are going to be supporting. Well, yields change over time, and I'm not going to go into the predictions of things, but I'm going to go into the current state of play around the different states and territories of which property markets are yielding at different returns. Northern Territory is winning at the moment in the regional markets, sitting at around 6.5% of the median. WA in Perth is sitting at 6.2. Then we've got South Australia sitting at 5.6. Queensland sitting at 5.3. Tasmania sitting at 5, Victoria sitting at 4.4, New South Wales sitting at 4.3, and ACT is not a category definition between metro and regional because it is all metro. And then if we look at the metro-only markets for Northern Territory, 5.8%, WA sitting at 5.3%, South Australia sitting at 4.8%, Queensland sitting at 4.5%, Tasmania sitting at 4.3%, Victoria sitting at 3.3%, New South Wales sitting at 3%, and ACT sitting again at 4% because it is only a major metropolitan area. So where are people going to start to look to put their money into as they look for these new markets that can support them? Well, yes, yields are good, but capital growth is obviously the full incentive here. And so the yields are going to be dependent on really what is going to attract those buyers into capital gains. And we know that the Tasmanian markets and the South Australian markets are at the turn cycles over the next sort of 12 to 24 months where we can start to see things happen. We know New South Wales regional areas are also doing very well in this regard. But the reality here is that when you start to take the top investor belt and those higher percentile properties and you put those buyers into markets which are now more affordable, you're going to also then start to create more rental stock. So the rental pressures in these markets could potentially start to ease off, but the capital gain is really where the competition is going to start to sit then, because you've got competition bidding inside these competitive areas, which will also in turn relax the top percentile of the market, meaning that those properties sitting at the $2, $3, $4 million value will start to ease off, and over time make those properties more achievable for house buyers and home buyers who are trying to enter those markets into those metropolitan areas. Now, this is all speculation, and it's obviously depending on what is going to happen from the Senate announcements and the coalition's final decisions on what the federal budget's decisions were to put forward for the next session until we have the next federal announcement. But to just add some justified logic around this, sentiment should not be dropped by decisions that are made by government today that impact decisions for the next 24 to 48 months or even 12 months. There are many, many years in an investment timeline. Many of your investment profiles are planned for around 10 years worth of development. The amount of decisions that can change within that time change drastically. And whatever decisions get made today really will not likely stand to be any driving factor that contributes towards a return in 24, 36 and 48 months time. Why I say this is because I really want to point out the fundamental, going back to the very first point that I made around the US and Australia, being that supply and demand and variety and opportunity does not exist in the same format in Australia that it does in the US, which is why the US housing market is so much more affordable than the Australian housing market. Fundamentally, the economics and the geography of our country makes for a very strong property market naturally for many, many years to come, until many, many more cities and statistical urban areas are built and developed to support the economic development and financial stimulation flow in Australia. I want to leave you guys with that today, and I hope that's given you a little bit more of a insight into how the property market in Australia has been formed and why it reacts in the way that it has. Because yes, there's going to be a lot of commentary online, and yes, there's going to be a lot of opinions, and I'm sure I'm going to probably get a whole bunch of comments back from this post, and I hope I do, because these are the kinds of topics and the subjects that I really like to speak about. But I'm putting this out there for your education purposes, because Australian property investing is certainly nothing to be woeful of. It is the most lucrative form of investing in Australia, as far as I'm concerned, at least. This is my opinion, and I think it's an opportunity for a lot of property investors to get into today, regardless of the decisions by politicians that are not controlled to the greater economics and geographies of Australia. So I do welcome any of these comments come through, and I actually like to sort of unpack them bit by bit. So please post them up, give me your ideas and your perception on things. Realistically, I am very, very firm of the belief that property investing in Australia will always be a very lucrative form of investing. Yes, we are an expensive country to live in, but that is the natural state of paying the price to be in such a beautiful land. Once our politicians decide on how to manage the borders and how to manage economic diversity and how to manage the stimulation process and manage dwelling development, once that all happens, which will happen, I have confidence in this, we will see that whatever the fundamentals are today will still continue to help drive property prices into the future. I have no doubt about that. And I have no doubt that Australia will prevail on all aspects, because we are such a great land and we have so many opportunities here. Guys, thank you very much for your time, and I hope you found this insightful and helpful to get you guys on track to thinking in the right direction around property investing and not being put off by the media and silly, uninformed legislative positions that won't have an impact in the long term, because property investing needs to be considered as a long-term strategy and not a short-term gain. Until next time, guys, thank you very much for listening to another episode of the Lazy Equity Podcast. I hope you enjoyed this format. I'd love to get your feedback and hear if you guys thought that this sort of a format was more helpful. Thank you very much again for your time, and we look forward to speaking to you next time on our next episode.